Welcome to Business Exit Success, the podcast dedicated to helping small business owners on how they can successfully transition out of their business on their terms while also living a life of purpose and fulfillment after the sale. I am your host, certified financial planner and certified exit planning advisor, Tom Poltersdorf. Hello, everybody. Welcome back to Business Exit Success. Today, we're digging into an essential end-of-the-year financial planning topic that if this applies to you and you don't follow the IRS rules, it can cost you a ton of money in penalties. And this rule is called the Required Minimum Distribution Rule, which states that for most retirement accounts, when you reach the age of 72, you must take out a minimum dollar amount from your retirement account. If you don't take your required distribution before year end, so in this case by December 31st of 2022, you pay a 50% penalty on the amount that wasn't withdrawn. You don't want to miss this one, folks. That's a huge penalty. Now, you may be asking yourself, who is the IRS to tell me I have to take money out of my IRA when potentially I may not even need it? And, oh, by the way, we pay taxes on that amount we take out. I've had clients say, I don't want to do this. Why would I do this? I don't even need the money right now. Well, that's the exact reason the IRS has this rule. They want to get paid. IRAs, 401ks, SEPs, these are all tax-deferred accounts. And the IRS says when you turn 72, you've pushed off not paying taxes on that money long enough, so it's time to take some out. Now, to illustrate this example, if you have a $300,000 retirement account in a prior 401k, a traditional IRA, a SEP IRA, and you are age 73, you'd have to take out around $12,000. If you fail to take that out as a distribution, you pay a $6,000 tax penalty on top of the normal ordinary income tax on the $12,000. Remember, any money taken out of a tax-deferred retirement account is taxed as income when distributed and will be subject to whatever tax bracket you're in. So if you're a business owner, you're doing really well, your tax bracket can easily get into the 30% plus range, especially if you're married filing jointly. So if this rule applies to you, please don't forget to take your RMD. The retirement account types that the required distribution rule applies to are traditional IRAs, SEP IRAs, simple IRAs, 401ks, profit sharing plans, and 403b plans, just to name the most common ones. So if you have multiple IRAs or 401ks from a prior employer, each of those individual accounts have a required minimum amount that you need to take out by year end. You can take it out anytime throughout the year, but by year end, that minimum amount has to be distributed from those accounts. A popular type of account that is not subject to the RMD rule, and that quite frankly I'm really a fan of for planning purposes, is the Roth IRA. So if you have money in a Roth, there is no required minimum distribution. Now, what if you're still working and participate in your employer plan? I get this question a lot. Do you have to take a distribution from your current employer 401k if you are 72 or older? And the answer is no. However, if you have a Roth 401k and you are age 72, then yes, you do have to take an RMD. If you have other IRAs or prior 401ks, then yes, you need to take a RMD from each of those accounts, but not your current 401k held at your current employer. If you wanted to avoid taking the RMD on those outside IRAs, you could simply consolidate those into your current employer 401k plan if the plan allows for it. So real quick as an example, if you had a $300,000 IRA, you could potentially transfer that into your current 401k plan and then not be subject to the RMD rule on the IRA because, again, it's not in there anymore. So pretty cool planning technique there. Now, if you are a business owner, there is a whole nother layer of complexity when it comes to RMD exceptions, okay? If you own more than 5% of the business, the still working exception will not work. If you own 5% or less of the business, you can delay the RMDs until you retire. So if you own more than 5% of the business, you will need to take a RMD from your current retirement plan that you have set up within your business, even if you are still contributing to it, believe it or not. So the 401k, the SEP, simple profit sharing plan, these are all common plans owners can put in place for themselves and could be subject to this rule. Now, why is this important for business owners? 40% of small business owners are baby boomers, which include many owners who are either approaching or over the age of 72. And many of these folks have no intention of retiring from their business. So tax issues really start to come up when you build a 7-figure retirement account. For example, if you are 73 and have $1 million in a retirement account, your required minimum distribution would be around $38,000. On a $2 million account, it would be over $75,000. So the numbers get really big pretty fast. Not only are the penalties outrageous if you don't take these, but those distributions are counted as income, which means it can push you into a higher tax bracket. It can affect your Social Security and make that also taxable. If you show too much income and you are on Medicare, your Part B and Part D premiums can be increased. So large RMD amounts can potentially spill over and add additional taxes in these situations, just to name a couple there. So with careful planning in advance, you can lower your taxes in retirement. The longer you wait to put a plan together, planning options become limited. For business owners, position yourself so that running the business is optional and not essential for you to live a comfortable lifestyle because you've become dependent on the income. So with that said, you all have a wonderful New Year's, and I will see you next time. Hey everybody, real quick before you take off, if you found this episode helpful in any way, please rate the podcast and leave a review. I would love to get your feedback and see if there are any topics you'd like to hear more about going forward. Thank you, and I appreciate you all very much.